name is Luis Galvez, Technical Marketing Manager with Wolters Kluwer Tax and Accounting, and joining me today are Ross Sullivan and Daniel Joseph, tax policy experts from the Brownstein Law Firm, to provide insights on recent tax policy news and updates. Today, we'd like to explore the tax benefits for individual taxpayers contained in the recent COVID legislation Congress passed. So, Ross, how much individual tax relief does the bill contain?
Luis, it contains a lot. The individual provisions are going to cost the federal government $200 billion. So that's about, on average, $1,000 for every American adult. Now, the centerpiece of this, of course, is a second economic impact payment or stimulus check. But the bill contains a few other provisions as well.
Well, let's go ahead and explore those stimulus checks first. We know that many Americans have already received this second payment by direct deposit. So, Daniel, who is eligible and how much will taxpayers receive?
Luis, individuals are eligible for the full amount if their AGI is no more than $75,000, then $150,000 for joint filing. Above that, the check amount begins to phase down to zero. However, the check amounts for adults are lower than the first round of payments. Rather than $1,200, each adult will receive $600. But the amount for dependents has increased from $500 to $600. Tax filers should also be aware that the eligibility requirements has been expanded to include and allow families that only have one spouse with a Social Security number to claim the payments. Also, taxpayers should know that the EIP checks are not taxable, so they don't have to worry about paying the taxes on the amount that they receive. And the payments that they receive are based on their 2019 tax returns. And if they didn't file their 2019 tax returns, they can claim the amount on their 2020 tax returns.
That's great news, Daniel. And so, Ross, what happened to the $2,000 stimulus checks that President Trump and House Democrats were pushing? Might that happen in the new Congress, or is it dead?
Oh, it's very much alive, Luis. You see, what has happened is that President-elect Biden has embraced the $2,000 per adult proposal that President Trump originally designed. And so now that Democrats have won control of the Congress, when they reconvene after the inauguration of President Biden, then they're going to be forced to try to pass a bill that would increase the amounts from $600 per adult to $2,000 per adult. Now, if they're successful, the IRS has already said, well, we can't take back the $600 checks or stop midstream. We'll complete that, and then we'll top it off with an additional $1,400 per adult.
Okay, so are there other provisions in the bill that can reduce a taxpayer's 2020 tax liability? And if so, what are they?
Yes, there are, Luis. Let's first talk about a provision that is called the Refundable Credits Lookback Rule. This is a provision that's going to help low-income taxpayers. As you are all aware, these two credits, the Earned Income Tax Credit and the Child Tax Credit, start at zero and increase as the taxpayer's earned income increases. In other words, if you're not earning wages, you don't get the credit. The higher your wages, the higher your credit. They're designed to encourage taxpayers to work. However, Congress recognizes that for many low-income individuals, particularly those working for minimum wage and just above that amount, they may have had their hours reduced or maybe even lost their job, so that their income for the year, their earned income, is lower. So to prevent a reduction in the credits, Congress says we're going to allow taxpayers to choose either their 2019 earned income or their 2020 earned income, whichever is higher or whichever produces a higher tax credits for them. So let's take an example. Assume we've got a married couple with 2 children, but they have earned income of a relatively low amount, $15,000 for 2019. Their 2020 earned income was even lower. It was $10,000. So the EITC that this couple would get at the $10,000 earned income amount would be $4,010, a pretty good amount. But it would be higher if they could use their 2019 level of earned income, or $15,000. In that case, their EITC would be $5,716, significantly more. So Congress said, just for this 1 year, 2020, taxpayers can choose either their 2019 or their 2020 earned income amount, whichever works out better for them.
So Ross, that could be a significant benefit for low-income individuals. Daniel, what about middle-income taxpayers? Anything besides the stimulus checks for them?
There are actually several provisions that could lower the 2020 tax liability for middle-income individual earners. Let me just summarize a few. The first is the deferred payroll taxes, which was issued through an executive order by President Trump. This executive order allowed employers to defer withholding the employee's share of the Social Security tax obligation for the last 4 months of 2020. This was to be recouped in the first 4 months of 2021. The bill spreads out the repayment period through December 31st, 2021. Second, educator expenses. Current law allows educators to deduct up to $250 in qualified expenses. The bill expands this definition to allow for personal protective equipment and other supplies used for the prevention of the spread of the COVID-19 pandemic. The last one I would like to summarize is the flexible spending account. The bill permits any unused portions to be carried over. It allows a 12-month grace period, and it also increases the maximum age of eligible dependents from 13 to age 14.
Thanks, Daniel. And finally, Ross, looking ahead, what about 2021? Does the bill include any items that will reduce a taxpayer's liability for 2021, or is it all about 2020?
Luis, it's almost all about 2020. That's where the big amounts are. But Congress did include a package of tax extenders. Those are provisions that would have expired December 31st, 2020. But Congress extended them, some for just a year, some they made permanent. There are at least 7 of these I'd like to highlight quickly. First, the itemized deduction medical expense floor has been set permanently at 7.5%, no more of this 10% amount that was in the law for a while. Second, the above-the-line deduction for qualified tuition has been folded into the lifetime learning credit, and those phase-out ranges for the lifetime learning credit increased to take the amounts that were applicable for the above-the-line deduction for tuition. Third, the exclusion for employer payments on student loan debt has been extended through 2025. The exclusion for discharge of principal resident indebtedness has been extended through 2025. Mortgage insurance premiums continue to be treated as deductible mortgage interest, at least through 2021. And the changes in the charitable contribution deductibility that were made last year during the COVID bill were extended for 2021 as well. That's it, Luis.
Definitely a lot of information, Ross. Thank you for sharing these insights on tax policies that tax preparers should keep in mind as they communicate with their taxpayer clients. You can download all of the information we shared today by visiting engagetax.wolterskluwer.com/tax-policy-news, where we'll be posting this video as well as other related tax news. So stay tuned for more updates. Once again, thank you, Ross, and thank you, Daniel, for joining us today, and thank you everybody else for watching. Bye-bye.